So I hope all of you can see the slide. So I'm going to talk about bank failures and other insights from the Economics Nobel 2022. So as Professor Shija already told you that these are the three economists who have won the Nobel Prize in economics. If you talk to colleagues from other disciplines in your university, they'll tell you that this is not the real Nobel Prize because Alfred Nobel did not set up a Nobel Prize in economics, but it was really the Swedish Central Bank which instituted this prize in memory of Alfred Nobel. So with that minor clarification done, we still celebrate this prize as a Nobel Prize in economics for very path-breaking and fundamental contributions to economics. Now, I'm particularly happy because this is the first time in the entire history of Nobel Prize in economics that research in banking has been recognized. In fact, the last Nobel Prize winner who had anything to do with money or monetary research was the great Milton Friedman, who was awarded the prize in 1976. So before that, 1974, Myrdal got the Nobel Prize for money. So since 1976, there has not been any Nobel Prize winner in anything to do with money or banking. So I think it was about time, and the choice is also fantastic for reasons that I will tell you. So what I'll do is I'll first tell you a little bit about the contributions of Douglas Diamond and Philip Dubwig. They have worked together on similar issues. So I'll talk about Diamond and Dubwig's contributions. Then I will shift focus to Bernanke and talk about Bernanke's contributions. And then what I will do is I will talk a little bit about how the view or the modern view of banking is changing, which poses some challenges to the research which Bernanke and Diamond and Dubwig have done. So I will talk about specifically two kinds of challenges. One on the role of banks in the economy. So what was understood earlier seems to be now changing, which kind of poses questions on the research that Diamond, Dubwig, and Bernanke did. Secondly, I'll talk about something which should interest particularly the students, which is cryptocurrency and central bank digital currency. You may have heard that the RBI is about to launch a digital rupee. So I'll talk a little bit about that to see how that digital currency introduction or digital rupee may change the way Bernanke, Diamond, and Dubwig conceptualized the role of banks in the economy. So therefore, there are three segments to this talk. First, contributions of Diamond and Dubwig. Second, contributions of Bernanke. And third, the challenges being posed to their research because of some new developments in banking and finance. Okay, so let me start by showing you the balance sheet of a commercial bank. Now, those of you who are economics or commerce researchers or students would be familiar with this balance sheet, which shows that a bank essentially collects some funds from some set of people and then deploys those funds in a variety of ways and earns profit through this activity. So on the liabilities and capital side, you can see, so look at the right hand side of the table, the bank collects deposits. From whom? From depositors. Could be people like us, could be companies. And the bank also has access to capital. What is capital? That is the money put in by the owners of the business, the shareholders. For example, in a public sector bank, that would be the money that the government has put into the bank. So that is capital. And there could be other sources of funds, other liabilities could be loans taken from other banks, etc. So what does the bank do with this money? So on the asset side, you will see that there is an important item called reserves, which is basically the money that the bank has to keep with the central bank. So in India, the cash reserve ratio is 4.5%, which means out of every 100 rupees of deposits collected by a bank, 4 rupees 50 paisa has to be parked with the RBI. So that's the cash held with the RBI. Then the second category is loans. So the bank can give loans. Of course, there are many restrictions on lending. I'm not going into those restrictions, but the bank can give a variety of loans and also other assets, which are other investments. So the bank can buy bonds, can buy shares, can buy gold. So those are the other assets held by the bank. So therefore, the two sides of this table have to match. The assets have to be equal to liabilities and capital. Okay, with that done, now think of a very important question. What does a bank really do? Does it collect deposits? Is that the role of the bank? Or does it provide an investment opportunity for the shareholders? Is that what a bank does? Or if you move to the asset side, does the bank create loans? Which is a very important contribution in the economy, generating loans so that households and businesses can use that money to finance their spending. Or does the bank create other assets, which means does the bank actually help to buy government bonds, which provides money to the government, which the government uses to finance its fiscal spending? What is really the role of a bank? I mean, if you think of a microeconomic production function, so think of a bank as a firm, a financial firm. So if you were to draw a production function of a bank, what would be the output? Let's say the inputs are labor and capital in a standard production function. What would you say is the output of the bank? Is it deposits? Is it capital? Is it reserves? Is it loans? Is it other assets? This is actually a very, very difficult question to answer. And different people have come up with different answers. One simple view is that bank is a financial intermediary, which means it collects deposits from depositors and converts that into loans. So that is one view. However, there are different views by different people as for the role of banks is concerned. So we now come to the contribution of Diamond and Dubwig on the role of banks. What do banks do? So what I'll explain now is based on two papers which the Nobel committee has cited in the Nobel Prize that they have awarded to Diamond and Dubwig. So these two papers are Diamond 1984 in a paper in Review of Economic Studies, and Diamond and Dubwig's paper in 1983 in the Journal of Political Economy. So this research is what led to the Nobel Prize which they have received. So what do they say in these papers? So first of all, they talk about the role of banks. So what do banks do? So if you think about a world where banks did not exist, suppose there were no banks, what would be the problem? So the problem would be, suppose I have some surplus funds, okay, I have some extra cash and I want my money to grow, but there is no bank. So how will I grow my money? Maybe I will lend it directly to a company or to another household who needs money. So suppose there's a company which wants to raise money so that it can buy a factory, or there's a family which needs money so that they can buy a house. So what would I do if there is no bank? I would try to find somebody who is in need of money and I would lend money to that company or to that family. So this direct borrowing and lending between the borrower and the saver is very difficult because these two have different needs. What are the differences in the needs? So those who want to save money, the depositors, they are looking for short-term opportunities to deposit money so that they can withdraw it anytime. Well, it's not going to happen. If you hand over your money to a company, you're not going to get it back before 10 years or 15 years because the company needs the money for long-term projects to set up a factory, and then it will produce goods, then cash flows will happen, then they will return your money. But the household or the saver is impatient. The saver wants to park money and take it out in a year or 2 years. So that is one mismatch of maturity. Maturity in the sense that savers are looking for short-term maturity for saving, but the borrowers are looking for long-term maturity because they need the money for 10 years, 20 years. Second mismatch is because of size. Now, individually, savers have some small amount of money. I may have some 20,000 rupees, you may have some 30,000 rupees, but a company wants to raise 1 crore rupees, or a home buyer wants to raise 50 lakh rupees. So, how will we satisfy the needs of the borrowers who need large sum of money when we have very small amounts of money to save? So, there's a size mismatch. And third, there's a risk mismatch. We want our money to be safe, so the savers, they want their money to go into low risk investments. But by nature of business, when companies are borrowing money, that is going to go into risky projects. So the money will be put into risk. It will be exposed to risk. So companies are looking for risky projects which they want loan for, but the savers want safe opportunities to invest. So there's a risk mismatch. So the bank actually solves the problem by playing the role of a broker or an intermediary who solves the problem of these mismatches. So the banks perform three important roles. One is maturity transformation. What does it mean? It means the banks collect deposits from us, which could be of 1 year or 2 year or 3 year fixed deposit, but it transforms it into a loan, which could be a 10-year loan or a 20-year loan. So that's a very important role bank is playing. We would not be able to do it ourselves. So the bank is collecting money from us. If it's a fixed deposit, it could be 1 year, 2 year. If it is a savings account, then actually I can withdraw it immediately or tomorrow. But that money is going to finance a 20-year loan. So the bank is performing maturity transformation. Short-term deposits are being converted into long-term loans. Second, the bank is doing risk transformation. The bank is keeping my money safe. My money, as in the depositor's money, is safe, but the bank is giving risky loans to the borrowers. So there's a transformation of risk. And third, there's a size transformation. The bank is collecting small size deposits and pooling them together and then giving out large size loans. So these are very important roles that banks perform, and Diamond in the 1984 paper actually shows that directly, if individuals like us, if we had lent out money to borrowers, we would not be able to monitor what they do with our money. It would be very difficult. It would be very costly for us as individuals to keep a check on what the borrower does with my money. But we are able to delegate that role to banks. So banks become specialists in monitoring of the loans. So they pool in all the depositors' money, and on behalf of the depositors, they monitor what the borrowers are doing with the money. And that helps to reduce risk. So that's an important role that banks play. Now, this has its own problems. So this financial intermediation role that bank is performing of collecting deposits, pooling the deposits together, and then giving out large and risky loans, this generates risk of something called a bank run. So think of a bank run as a bank collapse, a bank failure, a bank closes down. So that's a bank run. So the famous Diamond-Dubovik model is a theoretical model, a mathematical model, which shows how the financial intermediation of banks generates the risk of bank runs. So what I'll do is, first I will just tell you the story of the model. If you understand the story of the model, that is good enough. And then I will try to go into little details of the model by using some numbers as examples. But if you do not understand the example, it is fine if you at least understand the story that Diamond and Dubovik are trying to tell. So here is the story. The story is that depositors have surplus money. So who are depositors? They have some savings. So they want to save this money somewhere. So what would they do? They can invest this money in some financial asset. So they can buy some shares with it, or they can lend this money to a borrower, give this money to a company who needs money. But we know that depositors, they want access to liquidity. Why do they want access to liquidity? Because they are not comfortable giving up this money for 20 years. Even though I would like to deposit my money, I would like to have access to it so that I can withdraw it whenever there is an emergency in the family, whenever I want to go on a holiday, or I want to fund my children's education. I want to be able to withdraw my money. Now that is a problem because, as I said earlier, if I directly give this money to a company, I won't have access to it. So that is the liquidity mismatch, that the deposits are liquid but loans are illiquid, because loans cannot be called back, but deposits are liquid. I can withdraw my money anytime, but loans cannot be withdrawn anytime. So that creates a liquidity mismatch, and this is where banks step in, and the banks provide what is called liquidity insurance. So liquidity insurance is like a guarantee that the bank is giving the depositor, that don't worry, give me your money. Whenever you want to take out your money, you can come to the ATM or you can come to the branch and fill in a withdrawal slip or swipe your ATM card and you will get your money back. So that is called liquidity insurance. So the bank is assuring the depositor that give me your money, I'm going to make risky loans with it, which will be 20-year loans, and they carry risks. There can be defaults, but I assure you that you will get your money back, and with interest. That is very important, because if the bank simply gives me back my initial capital, then I might as well keep the money under the mattress, or I can keep cash in my cupboard. But why do I go to the bank? Because A, the money is safe, B, the bank will give me interest, and I can withdraw whenever I want. So that is the liquidity insurance that is provided by banks. And this is a problem. Why is this a problem? Because you see, when I go to the bank and say, give my money back, the bank can give my money back. But it's not really my money, because my money has been given out as loans. So maybe the bank has some cash in its vaults, which it is giving me when I am withdrawing deposits. But imagine hundreds and hundreds of depositors, or thousands or lakhs of depositors going to a bank branch on the same day and withdrawing their money. No bank on earth holds that kind of cash to meet the withdrawal pressure of a large number of depositors who may ask for their money to be paid to them at the same time. So what will the bank do? The bank will close down the shutter, and that is called the bank run. So bank run is when the bank shuts down or collapses because it cannot fulfill the promise it made to the depositor. It cannot pay the depositor their money back because it doesn't have the money. The money has been given out as long-term loans. So how does the bank create this liquidity insurance to the depositors, and how does that create a risk of bank run? So that is what the diamond to wick model is about. So let me explain to you what happens in the model using some simple numerical example. So this is the hard part. So there are two slides where I have done some numerical calculation to simplify the original model, which is a mathematical model, but you can understand this is a simple calculation. Suppose I have 1 rupee, which I want to invest. Okay. So today, let us say today is capital T equal to 0. Capital T equal to 0 means today. So suppose I have 1 rupee and I put 1 rupee in some investment. Okay. I buy shares with it, or I give that as a loan to a company. So what happens is after 1 year, so let's say capital T equal to 1. Capital T equal to 1 is after 1 year. After 1 year, the 1 rupee still remains 1 rupee. Money does not grow immediately. It will take time. Remember, the company has to first buy land, build a factory, then manufacture goods, then sell it in the market, then the cash flow will come. So there's a gestation lag. The money will not grow immediately. So if I put in 1 rupee in some risky investment, it will not grow immediately. So it continues to have 1 rupee value even after 1 year. So at T equal to 1, it still is worth 1 rupee. But after the end of 2 years, capital T equal to 2, which means after 2 years, which means if I'm patient and I wait, then my money will grow. So that's when the company builds the factory, sells goods and generates profits, and it gives me back 2 rupees. My money is doubled in this example. Of course, I'm exaggerating. In real life, you don't fall for money doubling scams. But let's imagine that my money will get doubled at the end of 2 years, not at the end of 1 year. Okay. So then let's imagine that there are some patient investors who are willing to wait. Okay. So we will call her a type 2 investor. So who is a type 2 investor? This is actually what Diamond and Dubik use the same terminology. A type 2 investor is a patient investor who is willing to wait for 2 years to withdraw her money, and she will be happy that her money will grow after 2 years. But then there are some others who want to withdraw their money quickly. So there could be some emergency in the family. I may need to withdraw cash. Maybe there's some health problems and I need my money back. So these impatient investors, or let's call them type 1 investors. So type 1 investors, they withdraw their money at t equal to 1. Okay, so these type 1 investors, they won't wait till t equal to 2. They will take out their money at t equal to 1. Now here is what the bank does. The bank is guaranteeing the type 1 investor, the impatient one, that you can withdraw your 1 rupee even after 1 year, and I will give you some interest. Remember, this is better than directly investing, because if I directly invest my 1 rupee, at the end of 1 year, I don't grow my money. I simply get my 1 rupee back. But it is better to go to the bank, because the bank is giving me a guarantee that don't worry, even if you are a type 1 investor and you are impatient and you want your money out after 1 year, I will give you your money back with interest. So that is the liquidity insurance that banks provide. Now the problem is that how many such impatient investors are there is not known initially. So if a large number of people say that give my money back at the end of 1 year, then there could be a problem. So let me give you one example and then I will talk about the implications. Suppose the bank has 100 depositors. So the bank has collected 1 rupee, 1 rupee, 1 rupee, 1 rupee from 100 people. Okay, so the bank has collected 100 rupees. It has pooled in this money and this 100 rupees has gone into a loan. Okay, so this 100 rupees has now been given out as loan to a company. Now at t equal to 1, this 100 rupees has not grown because the bank has given this to the company who is going to buy land, set up a factory. So at t equal to 1, the 100 rupees remains 100 rupees. Remember, only at t equal to 2, the money will actually grow. So at t equal to 1, the value of the asset is still 100 rupees. So if the bank tells the company, give my money back, the company can only give 100 rupees back. There won't be any increase in the money. Okay. Now, suppose at the end of the first year, 25 depositors turn out to be impatient. 25 out of those original 100 people, they say, we need our money back. Okay, there's some family emergency or we have some consumption need, give our money back. Now, notice what the bank can do. What the bank can do is the bank can give each of these 25 people 1 rupee 28 paisa. Okay, 1.28. It can satisfy the 25 people by giving them 1.28 rupees each, which is better than if these people had directly invested the money in a company, because then they would have only got 1 rupee back. But now they're getting 1 rupee 28 paisa back. Okay, so how does the bank do it? Now notice that the bank's 100 rupees, which has been invested in the company, is now worth still 100 rupees. So what the bank has to do is, it has to satisfy 25 people and it has to pay them 1.28 each, which means 25 times 1.28 is 32 rupees. So the bank has to pay out 32 rupees to these 25 depositors. And the asset value of the bank, which is 100 rupees at the end of 1 year, now falls because 32 rupees has been paid out. So now the bank has 68 rupees left. Now at the end of 2 years, remember, this 68 rupees will grow, because this 68 rupees is going to finance the land and factory, and the goods will be sold by the company. It will generate cash flow. So this 68 rupees will double. So when this 68 rupees doubles, it becomes 68 multiplied by 2. And then the bank will pay out the remaining 75 depositors who are the type 1 depositors who were waiting patiently for 2 years. So each of these 75 people now get 68 rupees times 2, because that money has been doubled, divided by 75, that is 1.813. So they are also happy. Although you could argue that if these type 1 patient investors had directly invested their 1 rupee, that 1 rupee would have doubled to 2 rupees. But they would still prefer to go to the bank, even though the bank is not giving them 2 rupees. The bank is giving them 1.813, which is less than 2 rupees. but they would still prefer to go to the bank, because in case there is a sudden emergency need at the end of 1 year, they can withdraw their money and still get 1.28. So that attraction of liquidity insurance keeps the people coming to the bank and depositing their money, because they know that if they're patient, they will get 1.813. If they're impatient, they will still get 1.28. So it is better than directly going and lending money to a borrower. So this is the liquidity insurance property of banks. Now this creates a risk. The risk is that in my example, I said 25 people withdraw their money at the end of 1 year. But what if 26 people, 27 people, 28 people, 30 people, more and more people have some emergency needs and they want to take out their money? Then what will the bank do? So this model is fine as long as not too many people take out their money. But suppose there's a panic, there is some crisis happening, or there is news that the bank is in trouble, or there is some news that maybe the bank is going to close down. So let's say a lot of depositors now run to the bank and try to take their money out. Now you don't need all the depositors to go to the bank. All you need is a certain critical number of depositors to go to the bank. In my example, let's imagine instead of 25 depositors, 79 depositors go and withdraw their money. So when 79 depositors go at the end of 1 year and withdraw their money, and the bank gives them 1.28 each, the bank has to give them 79 times 1.28. This is the money that the bank gives them to honor the promise of this 1 year deposit. Now these people go home with their 1.28, but remember there are still 21 people remaining patiently. Now you can do this calculation later and check that if the bank has given out this 79 times 1.28 rupees to 79 people, then how much money is left with the bank to now pay back the type 1 investors who patiently wait, those 21 people who patiently wait? I'll tell you the answer. The answer is zero. The bank will not have any money, which means the remaining depositors are not going to get their money back. So they will be worried. So once the number of depositors who are withdrawing their money increases from the original 25 to 35, 45, 55, 65, now the remaining ones who were patient are now getting worried. They are panicking that if the number crosses 79, there will be no money left. So this fear that there will be no money left, if more and more people are withdrawing their money, then by the time I go to the bank, my money will not be there. This panic makes more and more people rush to the bank, and naturally the bank does not have money to honor the depositors, and therefore it has to close down, and that is what is called a bank run. So this happens quite frequently in the cooperative banking sector, not so much in the commercial banking sector. So you can see the picture on the screen. This is a cooperative bank in Thrissur, which closed down last year in July because there were news that the bank has made some fraudulent loans and therefore the bank will suffer losses. So I, as a depositor, would think that my money is not safe. Let me go and get my money out. Now others are also thinking the same. And others are thinking that if enough people take out their money and I am at the end of the queue, by the time my turn comes, there will be no money left. The shutter will be down. So let me go and jump and try to be in the front of the queue. And everybody thinks like that. So everybody goes to the bank and takes their money out. The bank naturally has to close down. So why do banks fail? Why is there a bank run? Why do banks collapse? So it usually starts with some news or rumor that a bank is not doing well. So people worry and they pull out their money. And as we saw in the diamond to wick model, that if enough people take their money out, in my example, I had put 79 depositors take their money out, the bank runs out of cash. See another example here. This is another bank in Thrissur, which closed down last year around the same time, July or August, because there was a run on the bank. People panicked and tried taking out their money. And you can see some people are stuck. Some people here who could not take their money out before the shutters closed. So this is the risk that banks face. And how do we solve the problem? So how do we stop this panic or this rumor from spreading? So some people have said The solution is in the architecture. So the architecture solution is that have large lobbies. What will a large lobby do? Lobby is the reception area of the bank. Because if a lot of people are going to the bank and taking out their money, then the crowd will be inside. So people outside will not know that there is something going wrong in this bank. But if the people are queuing outside the bank, then passerbys will see that there's a long queue and they will get worried and they will call their friends and family and everybody will join the queue. The queue will get longer and longer and the bank will collapse. So the solution is create a big office so that the queue is inside and not visible to people outside. I'm just joking. This is not a serious solution. So how do you reduce the risk of the bank collapsing? So a common solution is to provide deposit insurance. So Diamond and Dubvig actually show in their paper that deposit insurance can satisfy the depositors or assure the depositors that don't panic, don't go to the bank and try to take out your money, because your money is insured by an insurance company. So there should be an insurance company who should insure the deposits so that even if the bank actually closes down, I will get my money back. So deposit insurance is very common across the world. In India, our deposits are insured up to 5 lakh rupees, which means even if my bank closes down, whether it's a cooperative bank or a PSU bank or a private bank, up to 5 lakh rupees is guaranteed by the Deposit Insurance and Credit Guarantee Corporation of India, DICGCI, which is actually a RBI subsidiary. So this insurance company is run by the RBI. They insure our deposits, so our money is safe. So this was a very important message which Diamond and Dubvig gave in their theoretical model, which has convinced the policymakers that it is important to have deposit insurance so that depositors will not panic and they will not take their money out, and that will prevent banks from collapsing. Of course, deposit insurance is only one solution. There are many other solutions which have been suggested, some by Diamond and Dubvig, some by others. For example, lender of last resort. So lender of last resort means if a bank is in trouble, it should be able to borrow unlimited amount of money from the central bank. So in India, the RBI lends money to banks at the repo rate, but there's a cap on how much money you can borrow at the repo rate. But there's another interest rate called the MSF rate. MSF rate stands for marginal standing facility. So banks can borrow unlimited amount of money at the marginal standing facility rate, which is 0.25% higher than the repo rate. So repo rate is 5.9%. The MSF rate is 6.15%. So RBI will give unlimited amount of loans to banks so that they don't have to close down. At the MSF rate, these loans are available. Second solution is stop people from withdrawing the money. So the government or the RBI, not really government, RBI will tell the banks that give depositors their money in small amount. Don't let them take out all their money. So freeze the deposit withdrawal. So that also happens. RBI intervenes and says that you cap the amount of money people are taking out. And then there are other regulations which are available to reduce the risk of bank failures. So folks, so far I have talked of Diamond and Dubvig's influential work, which gave this realization that look, banks are performing an important role in the economy as financial intermediary, but this generates the risk of a bank run, and the risk of bank run can be reduced through appropriate regulations such as deposit insurance. So this was the contribution of Diamond and Dubvig. Now let me move to Ben Bernanke's contribution. So what is Ben Bernanke's contribution? Some of you may have heard of the Great Depression. So the Great Depression was a long period of about 15 years in the US and also in other developed countries, when the economy was collapsing, GDP was falling, unemployment was rising. For many, many years, it was far worse than the COVID crisis or the 2008 financial crisis. So it's called the Great Depression. Now, traditionally, it was believed that the Great Depression happened because aggregate demand had fallen, which means people were not spending money. Companies were not spending money. So that was responsible for Great Depression. That was the traditional view. And indeed, events had happened. Stock market had collapsed. As stock market collapsed, people who had invested in stocks, they lost their money. Companies also could not raise money from the stock markets. So they cut down on spending. As they cut down on spending, aggregate demand fell and GDP fell. So that caused John Keynes to give his famous recommendation that the government should spend more money, and that will help the economy to grow through the famous Keynesian multiplier model. So the Keynesian multiplier will ensure that higher spending by the government will drive GDP up. So this was the traditional uh, problem diagnosis and solution to the Great Depression. Now, Milton Friedman had a different view. So Milton Friedman's view was that the problem was because people withdrew money from banks. So when people withdrew money from the banks did not have deposits to give out as loans. So you remember the money multiplier theory, which says that if banks collect deposits, they make loans with it. Those loans create fresh deposits. Those fresh deposits will create fresh loans, and it goes on and on and on. That is how money supply increases. That's the money multiplier model. So Friedman and Schwartz, Milton Friedman and Anna Schwartz, in a paper in 1963, said that this was responsible. This is why Great Depression happened, because people took out their deposits, so the banks could not create loans, and therefore the economy collapsed. And they actually blamed the central bank meaning the US Federal Reserve. They blamed the US Fed, saying that the US Fed should have responded to this by increasing money supply, which the US Fed did not do. And that is what created the Great Depression. So Friedman and Schwartz's solution was increase money supply when there is a crisis. In fact, Ben Bernanke in 2002 had very famously said in a speech that I would like to say to Milton and Anna regarding the Great Depression, you are right. We are very sorry, but thanks to you, we won't repeat the mistake. So he said that the diagnosis of Milton Friedman and Anna Schwartz was correct, that Fed did not increase money supply. And in fact, when 2008 financial crisis happened, Ben Bernanke was the chair of the Central Bank of the US, chairman of the Fed, which is like the RBI governor equivalent in the US. So Bernanke did not make that mistake. He actually cut down interest rates to zero, which is called zero lower bound, and he embarked on quantitative easing, which means flooding the financial markets with money. And that is how many people say that he saved the US from another Great Depression, by increasing money supply as a solution to the decline in GDP. Now, so far so good. This is not what the Nobel Prize was given. The Nobel Prize was given for Ben Bernanke's analysis of the role of banks in the Great Depression. So the paper is his 1983 paper in American Economic Review, where he analyzed a new reason why Great Depression happened. Remember, so far we saw the Keynesian diagnosis that a decline in demand caused Great Depression. Then we saw Anna Schwartz and Milton Friedman, who said that decline in money supply caused Great Depression. Bernanke gave a new explanation. So Bernanke's explanation was that banks do a very important role. They collect valuable information about the borrowers, KYC and all that. So banks know the credit worthiness, the income, occupation of all the borrowers, their cash flows. And therefore, when a bank fails, this information is lost. So when a bank collapses, all this valuable information or data about the borrowers is lost. And then these borrowers find it very difficult to access loan from somewhere else. Now, this does not hurt the big companies. The big companies can go to the share market or bond market and raise money there. But the small borrowers, like small businesses, family businesses, households, farmers, they suffer, because when the bank shuts down, they get cut off from the loan market, because the bank was giving them loan based on the information bank had collected on them, and that information is lost when a bank collapses. And because in the Great Depression, the bank failures cut off credit access to the small borrowers, they therefore did not have money to spend, and that is what caused the Great Depression to prolong for a long time. So this was a new explanation given by Bernanke for Great Depression. And therefore, what is the recommendation? Remember, Keynes's recommendation was increase government spending. Friedman and Schwartz's recommendation was increase money supply. Bernanke said the recommendation is banks should be regulated very carefully so that banks don't collapse. Because if banks collapse, it could cause a big crisis. So this was the 1983 paper for which he got the Nobel Prize. Now let me take another 10 minutes, shall we say, to talk about the modern developments, which is kind of posing a challenge to Diamond, Dubwig, and Friedman's contributions. So the first one that I want to talk about is a paper in the Bank of England's quarterly bulletin in 2014 that actually challenges our so-called textbook thinking about banking. Now, the textbook thinking comes from Diamond, Dubwig, and Friedman, and people like them who have developed these theories over the years. But Bank of England is saying, sorry, that's not how the real world works. So what is the first misconception? So Bank of England is saying first misconception is that banks are intermediaries who collect deposits and give out loans. Bank of England is saying that is wrong. Banks don't convert deposits into loans. Remember, Diamond Dybvig model was about banks collecting deposits and converting it into loan. In fact, Bank of England is saying it is the opposite. Deposits don't lead to loans. Loans lead to deposits. It's counterintuitive, but they're saying the opposite happens. First, the loan is created, then that causes deposit to get created. How does it happen? So imagine you go to a bank and ask for a loan. Do you think the bank will fill a suitcase with cash and give you the suitcase? No. How will the bank give you a loan? The bank will credit the money in your account. So the bank will say, okay, your loan application has been approved. We have credited the money in your account, which means the bank has created a deposit in order to give the loan. So first the loan decision was taken and then the deposit got created. So which means that banks don't convert deposits into loans, but rather the banks convert loans into deposits. So this modern view about what banks do poses challenges to the Diamond Dybvig's financial intermediation model. Second, the textbook thinking is that the central banks control what is called base money or high powered money, M0. And by changing that base money through the money multiplier model, money supply gets affected. That is what our textbooks, macroeconomics books tell us. So the Bank of England is saying reality is not like that. It is not that the central bank changes reserve money, which will change money supply in the economy. What do the central banks do? They decide policy rates, interest rates. So they decide the repo rate, like RBI chooses the repo rate. RBI does not choose reserve money and money multiplier model kicks in. The RBI chooses the repo rate. So what do banks do? Banks first decide how much money they want to lend because their objective is to make profits. So first they decide that I'm going to give this loan, and to give this loan they create deposits. And when they create the deposits, part of that deposits has to be kept as CRR balances with the RBI because of the cash reserve ratio requirement. That changes the reserve money. So it is the other way around. It is not that change in reserve money causes change in money supply, but the lending decision of the bank causes change in the reserve money. So it's completely opposite of what Bernanke was saying when Bernanke gave his explanation for the Great Depression, that it was a failure of banks that caused small businesses to lose their loans, and therefore it caused a slowdown in the economy. Well, the modern view is that no, it is not that the central bank is responsible for money supply. The central bank changes interest rates. The banks decide money supply based on how much they want to lend. So this is very interesting because what I want you to notice is that even Nobel laureates whose contributions get recognized can come under criticism, as I think John Keynes had said that when new facts emerge, I change my mind. What do you do? So in that sense, when new thinking comes, old thinking will get challenged. So there's we need to embrace new thinking, but that does not mean that we should not celebrate the old thinking. Now there's another one. This is my last idea. Another new development which is going to challenge the contributions of Diamond, Dybvig, and Bernanke. So this is central bank digital currency. So RBI has issued a concept note, interestingly, just 3 days before the Nobel Prize was announced. Nobel Prize was announced on 10th October. RBI issued the paper on 7th October, saying that RBI is going to pilot a digital rupee. So what is the digital rupee? Let me quickly run through this, given that I have taken up at the time that I promised, but let me quickly tell you about digital rupee. Uh, uh, Professor Shija, how much time do you think I have? Can I take another 5 minutes?
Yes, sir.
Okay, thank you.
Take your own time.
Okay, okay. No, because I think this is very interesting because this is the future of money. So let me talk about the future of money and how that may change the insights from the Nobel laureates research. So the future of money is like this. If you think of the evolution, we started from barter system, then moved to commodity money, that is gold and precious metals, then went to money which has intrinsic value like coins, then we moved to legal tender, that is paper money, and then let's say plastic cards and electronic money like UPI and NEFT and RTGS, and then cryptocurrency. So many people are saying cryptocurrency is the new money. But first, let me say cryptocurrency is not money. So why is cryptocurrency not money? Because money should perform three functions: medium of exchange, store of value, unit of account. Okay, so if any asset can perform these three functions, it is called money. Now, let me assure you, cryptocurrency does a very good job of two out of these three, but on one, it fails miserably. I'll tell you the answer. The answer is it is not a good store of value. The store of value means you put your money in that asset and it should hold value. But cryptocurrencies are so volatile, price fluctuates so wildly that it is not a good store of value. Therefore, it does not perform all the three functions of money. But cryptocurrency is very good as medium of exchange. If you want to buy a Tesla car or some stuff on the metaverse, cryptocurrency is very good as a unit of account, but not as a store of value. So what happened is this problem has been solved. In the last 2 years, there has been a new kind of digital currency which solves this problem, and that is called stable coin. Stable coins have proliferated in the last 2 years. In fact, since the COVID crisis, if you look at the data here, you can see the growth of stable coins in the last 2 years. So what is stable coin? Stable coin is a digital currency like a crypto, but it has the backing of assets. Cryptos are not backed by any assets, but stable coins are backed by assets. Since they are backed by assets, which means the company, so it's a private company like Tether or Binance or DAI. So they issue these stable coins, but they assure you that they're holding enough assets to support the currency that they have issued. And therefore, the value does not fluctuate. The value is always stable. And that is why it's called stable coin. And you can see the tremendous growth in the last 2 years from a few $1 million to now, more than $100 billion is the value of stable coins circulating in the world. But turns out stable coins are not that stable. So we still have a problem with the store of value function if the value falls. And prices of Tether, the most popular stable coin, rapidly fluctuated in a couple of days in May this month, which shows that stable coins can also fluctuate. So therefore, what do central banks do? Central banks came up with their own stable coin. So a central bank stable coin is a digital currency. So central bank digital currency is essentially central bank backed stable coin. So I have titled this as CBDC, that central bank digital currency, FOAM or FOMO. So FOAM is future of money, FOMO is fear of missing out. So there are both these reasons. One is central banks believe that this is the future of money, so they have to issue digital currency. Second, they're also afraid that if they don't issue it, then they will miss out on this revolution that is happening in the technology world. So how is CBDC different from stablecoin? Stablecoins are issued by private companies. CBDCs are issued by the central bank. Stablecoins are run by independent communities who are anonymous. CBDCs are run by the government and the central bank. Stable coins, there is competition, multiple stable coins. In case of central bank digital currency, there's a monopoly. In one country, there can be only one digital currency. Stable coins are backed by assets. CBDCs are also backed by assets, but more importantly, they are legal tender. It has got the RBI's, I promise to pay the bearer the sum of 500 rupees. That backing is there in case of central bank digital currency. So the RBI issued this concept note on 7th October saying that we are at a watershed moment in the evolution of currency. and therefore we are going to come out with the e-rupee. So let me tell you where the problem with the Diamond Dubig and Bernanke lies. Imagine the RBI issuing e-rupee. Let me just quickly come to how the e-rupee will work. Okay, so imagine the RBI coming out with e-rupee, which basically means that we will have, let's say, a digital wallet on our mobile phone. So our phone will have a RBI app in which there will be money. Okay, that's the e-rupee. And I can use that app to pay for a cup of tea or to buy food or clothes without having a bank account. So this is directly currency issued to me by the RBI. Now, the problem with e-rupee is that if that becomes very popular, that people start using e-rupee, then the need to save money in the banks may come down. People may not save money in the banks, particularly if the RBI pays interest on e-rupee. Notice that in physical cash, there is zero interest. If I hold a 500 rupee note, I will not get any interest. But if I have 500 rupees of e-rupee in my RBI wallet on my phone, the RBI can, if it wants, it can pay me interest. So my 500 rupees can become 510 rupees after a year. The RBI can pay me interest. If that happens, I may be tempted to pull out my money from the bank, thinking that banks are not safe and keep money in digital currency. In fact, even if the RBI does not pay interest, and the RBI said that we will not pay interest, we will have non-remunerated CBDC. Even in that case, there is a risk that suppose there's a panic, suppose there's a crisis, people get worried about the safety of their money in the banks. They may start pulling out their money and converting it into digital rupee and holding it in their RBI wallets, which will cause a risk to the financial stability of banks. Now, this is something neither Diamond, Dubig nor Bernanke have actually addressed. So they are saying that if you provide deposit insurance, banks will be safe because people will feel that their money is safe. But if there is a CBDC alternative where people can switch their deposits to, then this might pose a risk to, this might pose a challenge to the financial intermediation model itself, which is what the Nobel laureates research is about. So to conclude, let me repeat that the Nobel Prize research has shown us the role that banks play in the economy and the risk of bank failures and the kind of regulation that is required. However, I also told you that the ideas have been challenged. The role of banks as financial intermediaries is being challenged. Whether banks will continue to play the role of financial intermediation is also being challenged by digital currencies. Now, that will always happen. New ideas will come which will challenge the old ideas. That is how progress happens. That is how humankind has progressed. And I think we should embrace that. We should celebrate that. Each idea is exciting. So the Nobel laureates' contribution is exciting because they are the first who came up with a conceptual, theoretical, mathematical explanation for how banks work. So we should celebrate their contribution, but we should also celebrate new ideas which come and be open to changing our views as new evidence emerges and as new ideas emerge. With that, I will stop. Apologies once again for taking more time than I had planned. But if there are any questions, I'll be happy to answer.
Thank you, sir, for the enlightening address and honoring us with your presence. Next, we have the discussion session. Students may raise their queries to the professor. You may unmute your mic and ask the questions, or could use the chat box.
Okay, let me start with Vinayakan Sajeev, who has posted a question. What is the main difference between cooperative and commercial banks? How they work that makes commercial banks more likely to have a bank run? Actually, Vinayakan, cooperative banks are more likely to have a bank run in India. So you see more cooperative banks collapsing than commercial banks. But let me answer in two parts. First, what is the difference? The difference is in the structure of, let us say, the owners. So who owns commercial banks? The shareholders. Shareholders own commercial banks. Who owns HDFC Bank, Axis Bank, ICICI Bank? All the shareholders. If you buy a share, you can also become an owner. What about PSU banks? The government is a shareholders. The government is the majority owner, and there are also public who hold these shares. In case of cooperative banks, they don't have shares. So you can't actually buy a share and be a owner. The cooperative bank is run by a cooperative, which means a group of people who are members of the cooperative, who set up a cooperative, get it registered, and then that operates the bank. So that's the difference, that commercial banks are shareholder run, cooperative banks are run by the members. Now, having said that, in India, commercial banks generally are perceived to be safer because PSU banks have the implicit guarantee of the government that if anything goes wrong, the government will help the bank. In case of private sector banks, because they are generally well run, the capital levels are very high, non-performing assets are very low, their size is very big. So we associate the commercial banks with more safety. But cooperative banks, because they are small, because there is some non-transparency, we don't really know, because they are not going to publish the detailed audited accounts or their risk management models like commercial banks do. So we don't really know what is going on inside, who is running the cooperative bank, where is money coming from. So therefore, there are higher risks associated with cooperative banks, and you see more failures in the cooperative banking than in commercial banking. Meera has a question. How will monetary policy change with the advent of CBDC? So, Meera, you have given me an excuse to open my slide again, but there was one slide I had missed out, but let me quickly show you because I think economic students will find it interesting. So let me go back to my slides and show you the balance sheet of the RBI. So this is standard macroeconomics textbook central bank balance sheet. So the RBI has liabilities and RBI has assets. So on the liability side, notice currency in circulation. That is the currency that the RBI has issued. So what will happen with CBDC? This will get split into two parts. One part will be currency in physical form, and the second will be digital rupee. So look at the left-hand side. Now we have two types of currency. One is the physical currency, which is currently present. And secondly, we will have the e-rupee, which is the digital currency. Okay. Second, on the asset side, what does the RBI hold? The RBI holds domestic assets like government bonds and holds foreign assets like foreign government bonds, gold, forex reserves. So there also we might see digital currency. So on the asset side, we might see e-yuan, e-dollar, e-pound being held by the RBI, as well as stable coins, maybe NFTs, which are digital assets, etc. Now, you see, the answer is there is no change that will happen to monetary policy because all that happens is the composition of the liability and asset changes, not the size of the balance sheet. So the same currency now gets decomposed into a physical part and a digital part. The same assets get decomposed into a physical part and a digital part. So essentially, there is not going to be any impact on monetary policy as such. It will just change the form of money that we use, and we hope that it will improve perhaps transmission, velocity of money if CBDC is easier to use rather than physical money. But in that sense, it may improve efficiency of monetary transmission, but otherwise it does not do any fundamental or structural changes to monetary transmission. Annie, a very interesting question, stable coin versus CBDC. So this is like, the private sector versus the public sector. The battle will go on. So stable coin is a private sector initiative. I mean, many companies, so it's a competition, whereas CBDC is like a government, central bank. So private sector is better at innovation. So private sector will always have better technologies, more innovative use cases, which will keep people attracted towards stable coins. And central banks will try to catch up with it. And what central banks are doing is currently in the European Union, they have put a cap on stable coins. So they have said that there cannot be more than 1 million euros of stable coins traded in Europe if the stable coin is backed by US dollars. So central banks are going to regulate stable coins to prevent it from giving competition to the official CBDC. But I think both will coexist because stablecoin is going to be technologically more innovative since it is private sector driven. CBDC will try to keep innovating and keep themselves more attractive to the public. But the difference remains that stablecoin is not legal tender. It's at the end of the day a private currency. So if you go to your local Reliance Fresh and buy 1 kg of rice and you pay with stable coin and the manager refuses, you can't go to the police station. But if you pay in CBDC or in physical cash and the manager refuses, you can go to the police station because it's legal tender. You are protected by the law, but you don't have that protection in case of stable coin. So that difference will remain. Manju, interest rate and CBDC, well, so what I was saying is that suppose the RBI, let's say, wants to increase the use of cash and increase, let's say, money supply. So it can start offering interest rate on CBDC. So if I have 500 rupees in my digital wallet, the value may increase if the RBI starts giving me interest. Currently, that is not possible because the interest is only given by the banks if I deposit the money in the bank. My cash does not. But in case of CBDC, my cash, that is the digital cash, can actually grow. So this can also become a means to do direct benefits transfer. Let's say the government wants to give cash to poor people. It can simply ask the RBI to transfer that through higher interest or higher payments into their digital wallets. So in that sense, the interest rate works directly between the RBI and the public in case of digital currency, which is not possible in case of cash. But then there is the risk that if the RBI actually does it, it will cause a risk to the banking system because then people may not keep money in the deposits. So RBI has said that so far in the concept paper, they have said that they will not pay any interest rate on digital currency. That is what they have said so far. But if there's a crisis, who knows, they might be tempted to do it. Atul, large banks have more immunity against insolvency. With current rate of insurance, there has been increasing case of adverse selections, increasing risk of default, and due to sheer size of these banks, risk of possible recession. That is true. So this is the problem of too big to fail. So banks who become too big, they might become even arrogant that we will take risks. But even if we fail, the central bank or the government has to bail us out because if we fail, we will bring down the entire system with us, which is what Lehman Brothers had thought in 2008. But then they were not rescued and that triggered the financial crisis. So this problem is always there. So what do you do? On one hand, you need big banks because big banks can give big loans and we need to generate big loans to satisfy the needs of growth of businesses. So our companies who want to grow, they want big loans and many Indian banks are not able to give that. So Indian companies have to take loans from foreign banks. So we want our banks to be big enough to service the needs of these companies. But on the other hand, if the banks become too big, then they might create the problem that Atul is posing. So I think we need a balance. We need a few big banks who can give each other competition. So let's say 4 or 5 big banks. And if you think about it, that was the reason why the government went ahead with the merger of a few PSU banks a couple of years back. The purpose of the merger was that let's have a few big banks so that there is competition, but also there will be the ability to give large loans. Revati, modern theory, loans lead to deposits. What is the source of money that is lent? Yeah, so it is like this. Suppose you go to the bank and say that I need a loan. So the bank is doing nothing but simply making an electronic entry almost out of thin air and crediting your account. Now, where does the bank get that money from? Is as long as the bank is able to have a balance in between its assets and the liabilities, it can give you any amount of money it wants. So in a bank's balance sheet, remember, I said on the liability side, there is deposits, and on the asset side, there is loans and capital. So the bank will simply make a matching entry on both sides. So it is going to increase the amount of loans on its balance sheet by giving you the loan, and also increase the deposit entry on its balance sheet by creating a deposit in your name. So it actually doesn't need any funds. It just creates two matching entries on its balance sheet. So many people say, therefore, that banks create money out of thin air. So that is exactly how banking works. Sri Lakshmi, yes. So that is the idea that banks simply need to make two matching entries. Let's say you want a 100 rupee loan from a bank. So the bank will create 100 rupees of deposits and 100 rupees of loans so that both sides of the balance sheet match. So you will find that you have a 100 rupee loan, which is in the form of a 100 rupee credit entry in your statement. Anjana, yeah, so Bitcoin is a kind of cryptocurrency. So cryptocurrency is the general term. Bitcoin is an example of a cryptocurrency. Now, cryptocurrency, according to me, is simply an investment asset. You can buy and sell. If the price goes up, you sell, you earn profit. If the price falls, you earn losses. So it is an investment asset. It is not money. It is not currency, even though the name says currency and coin. But I think it is just like investing in shares or investing in bonds. Well, it is worse than that, because in case of shares, you are buying ownership in a company which exists. In case of bonds, you are buying a promise that you will be given an interest and your principal back by a company which exists. The problem with cryptocurrency is there is no asset backing that promise. So the promise is simply based on the belief that its value will continue to grow in future. Why will the value continue to grow in future? Because as you create more and more cryptocurrency, it becomes more and more difficult to mint new currency. So there is a perception that there will be less and less supply and more demand. Supply will come down because it requires computational power to create cryptocurrency. And as more and more cryptocurrency gets created, the computational requirement is higher and higher. It is getting more and more difficult to mint new bitcoins. So therefore, supply growth is less, but demand growth is high. So you know what happens when demand is higher than supply, price will increase. So that belief is what is causing people to buy cryptocurrencies. Belief that price will continue to go up, so I will sell and make profit. But it is not money. It is not money because it does not have store of value, because its price fluctuates and there is no control over that. Adit, about predictions about a recession, hard to tell, but most experts have said that there is going to be a recession in Europe, even in US. So in US, the central bank is increasing its interest rate continuously for many months now. From at a point of time when it was 0 to it has gone up to 3 to 4% now. So this increase in interest rate obviously makes cost of capital high. So companies and people will find it difficult to borrow. Therefore, they will cut down on borrowing, cut down on spending, and lower spending is the risk that people are worried about, that it will cause a recession. So what can happen is, maybe the Ukraine crisis will get solved. So suppose the war stops, then immediately the supply situation improves. So if the supply situation improves, then commodity prices may fall and inflation may drop. Then the US Fed does not have to increase interest rates anymore. So that is one possibility, that the recession may not happen if the global supply situation improves, if peace is restored. If that doesn't happen, if the US Fed has to keep increasing interest rates, then in theory, that is going to cause a recession. In case of India, of course, the RBI is also increasing repo rates. But so far, because we are far below our potential output or full employment GDP, so we don't have a risk of recession, but we certainly have the risk that our GDP growth rate will be slowing down. And that's what the forecasts are doing. Every forecast you see, recently the IMF downgraded India's growth projection from 7.2% to 6.8%. World Bank has said 6.5%. So our growth will be slowing down if there is a recession in the developed countries, but it's hard to predict. Vinayakan, India will be immune to the extent that our fundamentals are strong. As an economy, we still have the largest labor force, a cheap labor force, skilled labor, talent pool, which will continue to attract foreign investments, particularly because many foreign investors are realizing that they need to diversify away from China. So they may invest in India. In fact, that is already happening. Our FDIs are quite healthy. So if investments continue to come in, attracted by the strength of the Indian economy, and plus if the government makes doing business more friendly in India, then we should be able to withstand a global storm. But of course, it will hurt us because we are not decoupled from the rest of the world. For example, our exports will slow down. So if the world does not have buying power, they will not buy from us. So our exports will suffer. So exports growth is the concern. But on the other hand, if there's a recession, imports may become cheaper. And we import a lot of oil, we import a lot of gold. So while there may be some relief on the import front and therefore inflation may come down, but growth will come down because of a slowdown in exports. Archana, working principles are known to the common people, avoid bank runs. Yeah, that's a good point. I think financial literacy is a very, very essential part of having a mature, mature economy. So if people are going to discipline the banks, then the banks will not create mischief with people's money. So banks will be more careful in giving out loans if they know that depositors will take out their money and go to another bank. So I think financial literacy is important. Also, RBI needs to make it easier to take my account from one bank to another bank. RBI is working on it, but right now it's very difficult. Suppose I'm not happy with my bank. I want to close down the account and go to another bank. It's not very easy. So we need that portability, which is now there in mobile phone. I can change my mobile provider and retain the same number. So we need that kind of flexibility in banking, which will then discipline the banks and reduce risks that they take. Okay, I suppose you have run out of questions. Dr. Shija, shall we end then?
So there's a question in the chat box by Sam. In the period of a panic, as you said, people try to convert their assets to e-currency. So how do you think it will help the small-scale retailers to access the loans, and how digital economy can pump money to cure the depression?
Yeah, okay. So there are a lot of points in the same question. Let me think about it. So yes, there is a view that digital currency may actually help the informal sector, the small businesses, the unbanked population. Uh, Currently, maybe there's an advantage which large companies have, because even if there's a crisis, they don't get affected. They can always raise money from either the financial markets, stock markets, or even banks will continue to give them loans even when there's a crisis. So small borrowers have a disadvantage, particularly those who don't have bank accounts. Think of the person selling tea, the person fixing shoes or furniture, the carpenter, the electrician. So if there is central bank digital currency and there's a crisis, the government or through the RBI can immediately reach out and ensure that there is liquidity available to these small businesses so that they don't get affected by the crisis. So right now it's very difficult because you have to work through the banking system. So in the COVID pandemic, the RBI introduced targeted long-term repo operations, TLTRO, which said that banks can take loans from the RBI and not worry about returning it in 2 years, because normally the loans are made for overnight or 1 week. But in this case, the RBI said you don't have to return till 2 years, as under the assumption that you give this loan to small businesses. But it's very difficult because banks don't easily give money to small businesses because of credit problems, because they don't have mortgage security, etc. So those last mile gaps can be closed through CBDC, which is why the RBI and many other central banks have said that it is going to be good for financial inclusion. We can support small businesses and unbanked population through digital currency.
Now, there's one more question that you missed. That is, what is the future of traditional money in the light of acceleration of the launch of cryptocurrency and digital currency? Can digital currency actually have capacity to demonetize the world?
So you see, the future is unknown. 10 years back, we did not know that we will be delivering this lecture online. So, anything is possible. In another 10 years, physical currency may disappear. It's quite possible. But I think there'll be a transition. So in the medium term, we will see coexistence of physical currency and digital currency. Both will coexist because it will take time for people to adapt to digital currency. But if you look at the pace at which people have started using UPI, it gives some hope that people will also adopt digital currency very fast. So, but then there are concerns. So I didn't talk about the negative sides. There are concerns about loss of anonymity. Remember, with digital currency, RBI will have data on every cup of tea you buy, every movie that you watch. RBI knows what you're doing with the money. So potentially, you could get cut off from the financial and monetary system if the RBI does not want you to spend money. For example, let's say the government does direct benefits transfer in cash. So one of the problems currently is that people may take the cash but spend it on liquor, alcohol. Now in CBDC, that problem can be solved because the RBI will program it in a way that if you use that money in the alcohol store, it will not work. You only need to use it to buy a LPG cylinder or to buy food. Then the money will work, which cannot be done with physical currency. So which means that on one side, it is good. The government and the RBI can actually ensure that the money is being put to proper use and not being wasted on liquor or lottery. But on the other hand, the anonymity of transactions is gone. The RBI will hold data on what are the transactions you are doing. So I think it depends on how much people will trust CBDC. So till the full trust is gained, there will be a transition during which physical currency and CBDC will coexist. I see a raised hand from Bernard. Would you like to ask the question? Go ahead.
Yes. So I have got some little concern about CBDC, and I would like to give you a scenario of a certain country which is currently using mobile money, and I want to know the difference between the two.
Yeah.
Yeah, we have got like my home country, Kenya, we are using mobile money. Like, let's say, for example, if it was in India, we could call it cash rupees, yeah, M rupees, mobile rupees, yeah.
Yes.
In a way that in my mobile, I have got access to money and it can be used as a level tender. I use it in supermarkets. I can use it in even in most of the government institutions. Nowadays, we don't use cash, but we use the M money, which is M just mean mobile money. So I want to know what is the difference between the current, what we are using and the CBDC that is yet to come.
Yeah, Bernard, did you mention Kenya?
Yes.
Yeah. Okay. So, folks, I mean, you might know that Kenya is one of the pioneers in mobile money, which is what Bernard mentioned. Now, the only problem with mobile money, or let's say in India we use UPI. Even in India, you will see people making payments from their mobile phones. Is that you need an intermediary? So the intermediary could be a mobile phone company who is running some payments solution, or it is a bank who is providing this app. So you need a third party. So in case of CBDC, it is a direct relation between the central bank and the citizen. It does not require any intermediary to play any role. So whether good or bad, that is the difference. So the bad is, of course, intermediary is often more innovative. It can provide much better service. The central bank at the end of the day is the government. So that is the problem of CBDC. But on the positive side, it means you don't need to have a bank account, or you don't need to have an account with a mobile company. You can directly have money being credited to you by the central bank.